Hello Sector Watchers, welcome to the show. This is the 82nd episode of Sector Spotlight for Tuesday the 1st of June. Recording it on May 31st, which is Memorial Day in the US. So all of you who are in the US, I hope you had a great, Memorial Day weekend, Memorial Day. Anyway, I hope you enjoyed your long weekend and had a good day yesterday. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Today is the first Tuesday of the month, and the regulars know that that means that we're going to look at monthly charts here in Sector Spotlight. And because last week I spent some time going over a different subject, we didn't get to do the seasonality outlook. So I'm going to try and squeeze in both the seasonal outlook for June as well as the completed monthly charts for May in this show. And therefore, let's get started. Because we have two big segments in the show, two big subjects, I'm going to keep the overview for last week really short. And as a matter of fact, there's not a lot has happened. If we look at the asset classes, then we see that VBI-index, our benchmark, rose 1%. Primarily driven by a 1.5% gain by ITOT, which is the total US stock market index ETF, and the fixed income complex LQD, GOVT and HYG gaining between 10 and 40 basis points. That's pretty much what makes up our index, and what I think is most interesting is that it's all taking place very close to the benchmark. So not a lot of deviation from the benchmark, not a lot of big momentum moves, so it's all very tight together. Most impressive moves by commodities, they seem to be turning back up. They made a long turn from leading into weakening, and they seem to be picking up momentum again. If that rotation continues, then we could see a new lag in the big turnaround for the commodity markets that we've been monitoring here for the last few weeks. The other asset class that's doing really well is commodities. V&Q is turning back up. That's a very nice rotation here that we see on the daily. If we bring that all to the right hand side where we have the weekly RRG for asset classes, then we see still the strength for commodities here on the right hand side. GSG is the highest on the RS ratio scale. It's dropping on the momentum scale, but there's plenty of space and time for GSG to turn back up, and it looks like DJP has already done that last week. It came down and you see that it is hooking, jackknifing back up. And if you look at ITOT, it's continuing its trajectory into the weakening quadrant, but it's a very short tail, so stable trend there. The one on the other side, the biggest one, is GOVT. Started to pick up again, but still the position of GOVT versus ITOT remains a bullish scenario long term for ITOT. Near term, you see the weakness for stocks and the strength for GOVT, but the fact that they're far apart on the RS ratio scale means that the preference for stocks is still there. Moving to the stock market and the sectors, there we see that SPY, S&P 500, gained 1.2% last week, and overall it was a good week for the cyclical sectors and not such a good week for the defensive ones. If we look at the defensives, then we see all four defensive: utilities, healthcare, staples and energy, all at the bottom of the table. Utilities losing even 1.5%. If we go to the top of the table, then consumer discretionary was the strongest with a 2.5% gain, followed by communication services 2.5, real estate 2.2, industrials 2, and then technology 1.6, just a little bit above the 1.2 of the S&P 500. If we bring that to the longer term rotations that we see on the right hand side, then we are now in a phase where we have to wonder whether the strength of the cyclical sectors like tech, discretionary, communication services, real estate that we saw on the daily are strong enough to pull this back up, or that the weakness that we saw in healthcare and staples and utilities and energy, that is strong enough to make the tails on the weekly, and we're talking utilities, staples, healthcare, and here's energy, to turn around before they hit leading. I find it it's difficult to read. I tend to give more weight to the weekly because that's the longer term trend. That's the bigger picture. So for the time being, especially also because discretionary and technology remain inside the lagging quadrant. So the pickup that we saw here, if we zoom in here a little bit, then you can see that pickup, it's leading to a little bit of momentum gain for both discretionary and tech, although discretionary has already started to move lower on the RS ratio scale. But neither of those two sectors, and they're important sectors because of their weight, has managed to pick up relative strength. So as long as the weekly tails for discretionary and tech are not able to pick up relative strength, in other words, start gaining on the RS ratio scale, I'm going to consider and judge those stronger rotations on the daily as intermediate and within the longer term trend. And the longer term trend here for discretionary and tech is actually still weak. They're in a relative downtrend, that's for sure. My overall view for the stock market based on the current rotations remains one of caution, despite the fact that what we saw on the asset allocation RRG, where stocks are still to the right and bonds are still to the right, and we're going to see that later on when we talk about monthly charts, that the longer term trends are still all pretty good overall, I have to say. I still keep my caution based on the sector rotation, which still seems to favor the more defensive sectors. While we are still at the sector rotation charts, let's dive straight into the seasonality. And as you know, what I'm trying to do in this segment is to see if I can find outliers or significant over or underperformance in a sector versus the S&P, and compare that to the current rotation of that sector to the S&P and see if I can find alignments. So we're actually looking for sectors that are showing a strong seasonal performance, overperformance, or strong underperformance, and then see if we can find a strong positive rotation or a strong negative rotation on the RRG to match the historical average with the current rotation. And if we look at the seasonality for the month of June and beyond, then there's a few sectors that stand out. And the first one is financials, XLF. It has a reading of 35%. That means that in 35% of the months of June over the last 20 years, financials was outperforming the S&P 500. That means that in 65% of the occasions, financials was underperforming the S&P 500. And 65 and higher is a number where I get, try to add some validity, some value to that number. So 35, 65, that's the same, obviously. What you see here is financials is at 35%. We see technology at 30%. That means that 70% of the time in June over the last 20 years, technology was underperforming the S&P 500. That's quite a significant number. And then we have healthcare, XLV, which was outperforming 70% of the time. Now, what I started to do a few episodes or a few months ago was look after the next month, because seasonality doesn't really behave on a month-to-month basis. And what I see here is that for financials, the month of June is pretty significant. But then July is 55. That's sort of, insignificant, and the same goes for August at 40% to a lesser extent. If we look at technology, we see it's almost an outlier. It's 30%, so the month of June historically has been a pretty bad month for technology. But then it's picking up in July and August with 60 and 65%. Not massively yet, but definitely better than the month of June. And because we already had a bit of weakness for technology in May, it could be that we've already had that dip and we moved higher. So we need to put all of that in perspective. This is not an exact science. And then we have healthcare, which is showing 70% historically. And then it drops to 45% in July and it jumps to 65% in August. So that's kind of unchanged, but the month of June looks pretty good. Now, when we add performance figures to these numbers, to this table, then we see that financials is actually at minus 80 bips. So historical average return versus the S&P for financials is minus 80 basis points. On average, financials underperforms the S&P 500 by 80 bips in June. That's a significant number. And we have a weak rotation for financials. So, that seems to be lining up. And then we have technology, which, as we've seen, has a pretty significant number in terms of underperformance. And then the return is flat. So the average return for technology versus the S&P 500 is flat. That's not real negative, but it's far from really positive. And if we go to healthcare, that was the third sector where we saw some significant numbers. We see on average a gain of 80 bips in June. But look at this, it's followed by 2 flat months versus the S&P 500 in July and August. So healthcare has a high odds for outperforming the S&P in June, and then it falls flat after that. So if we look at that, you have high, and then you have 45 and 65. That's like it's not really the number that you want, and then you get 2 flats. So for healthcare, this really seems to be sort of a short-term burst, maybe I should say that. If we look at tech, we have 0 and then 0, 0.4. If you look at the outperformance numbers, it's a real weak outlook for June, but it's stronger in July and August. And if you look at the numbers here, then it's still flat and a little bit higher in August. So could have been like we're sort of going through a dip and then picking up a little bit. And then for financials, that is, a weak outlook for June, with the accompanying minus 80 bips historical performance. But then you go to 55 and 40%, which is around the average, and you see that we have 0.8 and then minus 0.1. So the 0.8 is quite significant. We go from minus 0.8 to plus 0.8, and that goes into 35, 55. All in all, it's these numbers look pretty solid, especially the 70 and the 30, probably the 35 as well. If you look at the rotations, that's also quite in line. So let me bring up those rotations and bring up the charts actually, because that's where the confusion gets even bigger maybe. If we start with financials, let me bring up financials here for you, then you see that it rotated through leading and it's now into weakening with a relatively long tail and moving lower. So that would fit a weak upcoming month. I could see for the 4 next observations in financials moving lower into the weakening quadrant, heading towards lagging. If I look at the chart here, then we see that financials are at the top of the chart, pushing against roughly 38, not being able to go higher. But when you look at the relative, that's actually, it's not bad. It's turning around. It's moving higher on the on the raw RS chart. But the RRG lines, they are detecting some sort of weakness in momentum, and that's probably after the break that we didn't get a serious follow-through or not a real acceleration. So that's why these are rolling over. The uptrend here in the sector on price is obviously still there, but there is some risk to the downside of the channel. So the current rotation and the historical pattern suggest that we will see some weakness in financials. There is room inside the channel to lose some value, to lose on price, and there is resistance building up around 38. And we see some downturn on the RRG lines, despite the fact that we're breaking out here. There is obviously some overhead resistance. So for financials, I'm going to stick with the expectation that we will see a weak month for financials ahead. Now move to technology. Obviously, we've already seen that. It's inside the lagging quadrant. Picked up a little bit, not moving further to the right, not picking up relative strength. And if we look at the price chart for technology, then we see that it actually is off its highs. That happened 4 or 5 weeks ago. We bounced off the rising support line, so the uptrend on price is still there, but the relative strength is still in the worrisome rotation, negative move, topish formation that we've seen in technology for a couple of months already. It's like 6 months, 7 months. So, well, maybe even more. This is August, so 9 months, 8-9 months. So it's quite significant. And you see that the initial decline in the RRG lines is now leveling off, but the tail remains inside the lagging quadrant. So here the rotation remains negative. The historical, so the seasonality is a negative, and the price performance, it's improving a little bit, but probably not enough. And if I bring that in, then I'm going to stick with my perception that technology is in a weaker spot right now, and that seems to be confirmed by the weak outlook for June. It could be short-lived because we've seen that July and August are better, both in seasonality and with a little bit better price performance. But for at least the start of June, I would say that technology remains a weaker sector, as a weaker outlook. And finally, we go to the healthcare sector. That's a nice move into improving. So that's strength. That's this exhibiting strength. And if we bring in the price chart for healthcare, then and here comes a little bit of my, call it a problem. This looks very much like financials. We're at the top of the channel. We've been struggling with, in this case, it's around 124, 125. Doesn't seem to go higher, so there's room to decline here. But the relative strength is still in a downtrend. It's not breaking out. Financials was breaking out of that longer-term downtrend. This one is not. But here the RRG lines are picking up momentum. So this price chart with the RS line is sort of contradicting what the seasonal and the rotations are showing us. Who's gonna win? Tough call. I am gonna stick with because healthcare is one of the more defensive sectors, and the overall rotation to defensive that's still going on under the hood. We see that here on the RRG. We see healthcare, staples, utilities. That's all pretty defensive stuff. We see weakness in the cyclicals like discretionary, tech, communication services, financials, industrials rolling over. So I'm gonna stick with the seasonal expectation. Although the price chart for both financials and healthcare are not like super confirming, maybe they're even a little bit contradicting. that could fit into the, and I'm going to bring back a table here, the outlook where we have healthcare being flat after that. So a good one for healthcare and then flattening out. A weak one for tech, but then flattening and picking up. And a weak one for financials and then picking up. And that's what you see here in the outperformance table as well. I hope I'm not too confusing, so I put it all in a table I do that for myself to just wrap it all up and get the picture right. And that means that for financials, seasonality is negative, current rotation is negative. Because it's on the right hand side, it could be neutral, but I'm more leaning towards negative, at least for the next 4 or 5 observations, which is the month of June. The average return for financials is definitely a negative. For technology, the seasonal is pointing downward, the current rotation is in lagging, that's pointing downward. The return, the average return is not super negative, nor is the price chart. So there's a seasonal and a current rotation with a so-so average return. And then healthcare has all the pluses. It's strong on seasonality, it's strong on the current rotation, it has a high average return, but there you have some sort of an issue with the price chart when you compare it to financials. Anyway, this is my view, this is what I'm going to stick to, this is what I'm going to monitor going into the month of June based on seasonality and current rotations. And we're going to wrap up the show with a look at the monthly charts, and I have made a selection because of the time that we have left. If we start with real estate, V&Q, then I think that's a very interesting chart on a monthly basis because we are just peaking to new all-time highs. The chart in itself is looking pretty good. You saw that it was good on a rotation, and we're now breaking to new all-time highs. So I think that the real estate asset class sector definitely needs our attention because it is breaking to new highs. And then the other 2 charts in asset classes that I want to share with you are the commodity charts. So DJP, you can now see that it is now definitely, last month it was just peaking above this resistance level. It's now firmly above it. And that means that the upside is now open towards the next major resistance level, which is around 30. But more importantly, the downside risk seems to be well protected now. So I'm pretty confident that commodities are getting better and better and better. And it also shows on GSG, where we see that the price is now definitely above that falling resistance line and has got the room and the ability to move higher. First area of resistance around 19 US dollars, and we're currently around 15. So real estate and commodities on an asset class level definitely worth our attention. If we zoom over to the stock market and we start with SPY, then we see that despite the few weeks of weakness that we saw in the various sectors, that SPY, the market itself, managed to squeeze in a new closing high as well as making a new all-time high in price during the month. It is marginal, it wasn't much, but it was a new all-time high and it was a new closing high. So that is still a bullish chart, let there be no doubt about it. Is there room for a decline? Definitely. Are we going to move significantly higher in June? I doubt it. But the longer term trend for SPY is still higher. And from the S&P 500 we go straight into the monthly charts for sector indexes. Communication services, not at an all-time high, it's still in a very nice uptrend. So that is a good sector, but it's not at an all-time high, not at an all-time closing high. We go to discretionary. It managed to squeeze in a new all-time high, but the close was definitely not higher. It came off the close there. The uptrend obviously still intact for consumer discretionary, but there is room to the downside. If we go to staples, then you see that it is still inside that rising channel. It managed to squeeze in a new all-time high as well as a new closing high. So consumer staples, bullish, still in an uptrend. We go to the energy sector, that is definitely in a downtrend. Still, it is pushing against resistance. Nowhere near an all-time high, nowhere near an all-time closing high. If we break that resistance level, there is a little bit more room to the upside. Financials. New all-time high and a new closing high. Definitely a bullish sector, definitely following through after that break. However, plenty of room to the downside, so this sector can go down to maybe even 525 area without hurting that longer term uptrend. And these are the risks that are in this market. They can go, some of the sectors can go significantly lower without harming the longer term uptrend. And I think that is the basic message that we need to keep in the back of our minds. Healthcare, after the break, consolidation accelerating, new all-time high, new closing high. That's a bullish sector. As a matter of fact, on the seasonal as well, as we've seen prior in the show. So this is lining up actually quite nicely. Industrials, new all-time high, new closing high, confirming the bullish trend. But look at this, after that break, breaking, consolidating, accelerating, there's plenty of space for this sector to go into a corrective move, to decline without hurting that longer term uptrend. But it can be quite significant, and there's a few sectors like that. So the longer term uptrends are intact, but the downside risks are increasing, and we can see declines without harming long term uptrends. Information technology, not at the new all-time high, not at the new closing high. We had a good run up towards the end of the month, because you see that the close was well off the lows. The uptrend obviously very clearly intact, no problem about that. But here also you can get some decline in price terms without harming that longer term uptrend. We go to materials, same story. Nice break, nice acceleration, still going higher, putting in a new all-time high and a new closing high in the month of May. Again, plenty of room to the downside. If it happens, it can be significant in percentage terms, in dollar terms, but before that uptrend is broken, that's going to take a little while. We go to the real estate sector. We talked about that at an asset class level. We see that confirmed here. Nice break to the upside. This looks as if it's just about to begun. You know, the other sectors that broke out had an acceleration, had a run up, and they're now sort of stabilizing, stalling. It looks as if real estate is only about to start its acceleration, and that goes both on the RRG as well as on the price chart, as well as on the rotation. And then if we go to utilities, then you see that it is not at an all-time high, not at a new closing high. Actually, it did not manage to pass its resistance level there. Nevertheless, that chart still looks pretty good. Not fantastic, but pretty good. Not a problem at all in terms of price trend. That's still solidly there. Now, if I wrap this all up, and I'm sorry, I apologize that I had to do it so quickly, but if we wrap that up and put it in a table that I started to maintain, then we see some differences. Here you see which sectors put in new all-time highs and new closing highs, and which are still in an uptrend, and what their market cap is. And if we sum that all up, then 44% of the sectors made a new all-time high and a new closing high. That's significantly lower than the 84% that we had last month. 94%, that's still the same number of the whole market is in an uptrend. So there is a little bit of weakness, but the longer term trend is still there. And I think that is the basic message. Tactical, short-term potential weakness coming up, long-term trends all solidly there. Just be on the lookout and be careful for the time being. Ladies and gentlemen, this concludes Sector Spotlight for this month. I hope you enjoyed the show. If you have anything to say, please use any of the handles on the screen. If you like the show, give us a thumbs up, and I hope to see you back next week at the same time. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please stay safe, and I see you back next week at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.